Good morning, everybody, and welcome to the webinar. My name is Carter Froelich, and I'm the Managing Principal of Launch Development Finance Advisors. And thank you for taking the time out of your morning to join me in this presentation. And today's topic is going to be turbocharging project returns with the launch bond. Before we get started, a little bit of house cleaning. We will be sending you these slides should you want them. At the end of the presentation, you'll see QR codes for myself and for Ryan Mills in our DFW office and Jose Almazan in our Houston office. If you scan the code, reach out to them, they will provide these slides to you. Additionally, should you want to set up a discovery call to talk about how we can turbocharge your project results and returns with the launch bond, you'll be able to do that as using the QR codes as well. So with that, let's get into a description of today's agenda. So before we get into the nitty-gritty of the launch bonds and how to turbocharge your returns, I think it's important that we get into a little introduction of launch and who we are and what we do, because that will set the framework for how we came up with the forward funding launch bond. Once we get through the introduction, we're going to be getting into the launch bond 101, what it is, how it works, how it's sized. And then after that, we're going to jump into showing you a real example of a project pro forma utilizing standard MUD reimbursements over time. And then we're going to show how the launch bond is going to turbocharge those returns. And then lastly, I'm going to get in and show you some selected launch bond closings and how those have benefited some of our clients in the past. So with that, and here's the firm propaganda material about us. So the thing you have to understand about launch is that our mission is to be a hero to the development and home building industry. Everything we do focuses on being a hero to you. And we do that by, number one, determining what your project vision is. Number two, determining what return metrics is most important to you, meaning is it IRR or is it multiple? Can't be both, because that's going to lay out everything that we do for you as it relates to a financing. Our niche in how we're a hero is we help our clients finance infrastructure. We help them reduce costs. Now, I'm not an engineer. I'm not going to come up with a better way to build a bridge, but we do have ways to have other benefiting landowners pay sooner rather than later, or having jurisdictions or agency pay their fair share. The third thing we do is we mitigate risk, meaning shifting it from you to others. And that is done all with the goal of enhancing project profitability and returns, thus the subject of today's call. The services that we prepare and that we provide for our clients are obviously in Texas, we do the launch bond. Two, in Texas, we also do PIDs, MUDs, MMDs, freshwater supply, TERS, etc. We are completely agnostic when it comes to what districts our clients are using. Different projects have different DOS requirements, meaning we may be in a city, the city's only going to let us do a PID, we can't do a MUD. So then how do we enhance project profitability with a PID if we can't use a MUD? The thing I want to be to let our audience know is that when we first came to Texas, and I came to Texas in 2007, we knew about the MUDs. We knew that they were a great vehicle. The problem with the MUD was, even though the developer was in control of the districts in most cases, until we had significant AV on the ground, we weren't able to issue any sizable bonds. And so it took a long time to get the MUD proceeds into the pro forma. This is what we solved, and this is a little bit of history. Now, at the time, we looked around to see how we could enhance project profitability and returns, and the only thing that was really available to us was the PIDs. However, the Attorney General had determined that that given the current architecture of local government code 372, that they did not feel comfortable in issuing bonds to be able to build out of bond proceeds. So they had a lot of what we call broken PIDs, or otherwise known as cash flow PIDs, where we just lay down an assessment and collect those assessments over time. Well, that didn't work for our clients because our clients need money sooner in the process rather than later. So we worked with the legal community, Vincent and Elkins and others, to change the law to allow us to build out of bond proceeds. And then we went and did the first bond in Central Texas after the 372 was amended to literally issue bonds upfront on a project called Whisper Valley and another one, Indian Hills, to build out of bond proceeds. So why is this important? This gets back to our reason for being. That is to be a hero to the development community. And if I were to tell you what is our purpose in business, it's to accelerate cash into the pro forma. And we did that initially in Texas with the PIDs in 2007. And that's going to, you're going to see this theme over and over as it relates to what we do. The other thing that's real important, and I just beat this drum all the time, and that we do is that we add transformative financing language into development agreements, annexation agreements, and financing agreements. Why? Because I want to create certainty on the part of the developer that if they ask the jurisdiction or agency to do something, that they're going to do it. And also to create flexibility, meaning as the market changes, we're able to adapt to that. The other thing, and one of the biggest issues that we see, everybody wants to get a district formed and they forget the back end, which is how do we process our reimbursements? And this is especially and most problematic with PIDs in Texas, is that, what are all the documentation we need to be collecting so that when we submit a reimbursement, we're going to get paid. And we do that with a huge database called the Launch Reimbursement System that tracks all of this necessary. And then all the necessary documents. So if you're interested in that, give us a holler. The other thing that I have found is that a lot of our clients have pro formas. They may be of different sophistication, but a lot of them don't know, or a lot of them aren't tracking when the reimbursements through the special district come in and how that impacts the pro forma. So we build a lot of custom models for our clients. As it relates to the entitlement process, oftentimes we'll do a lot of fiscal impact analysis showing the benefit of our project, either within the boundaries of the city or what the fiscal and economic impacts of our project will be to the agency's general fund. And last but not least, and this is becoming a bigger and bigger issue in Texas, and this really depends on who's paying us, is that we look at making sure all the development impact fees that jurisdictions are charging are reasonable, they're legally allowed by statute, and they follow case law. In other instances, the MUDs, the PIDs are not sufficient to fund all of the infrastructure, and we're actually looking at working with jurisdictions to add additional impact fees for reimbursements. This is bigger in other parts of the country. But here again, our job is to help our clients finance infrastructure. And sometimes we need to look at what those fee credits are to do that. So that's a little bit of the spiel of us. I should also mention before we jump into this that we're affiliated with Land Advisors organization. And so both Land Advisors and Launch operate from coast to coast and everywhere in between. And we are doing a huge amount of volume and work in Texas right now, because Texas, is the center of the universe as it relates to where all residential development is occurring, where the top markets are. So let's jump into today's discussion. Why are we here today. And why is this discussion especially important today? Well, as we sit here and on today's recording, what I see across Texas, whether we're in North Texas or down in Houston, is that our development costs are continuing to increase. Jurisdictions want more infrastructure. The infrastructure that is required to provide water, sewer, storm drain continues to go up. Roads are expensive, and the expectations of our master plan users, meaning the home buyers, continue to increase. At the same time, as of the date of this recording, sales, meaning home sales, are slowing, and that is impacting cash flow. So what are some other mechanisms we might be able to do to solve the declining amount of cash that comes into our pro forma? Number three, as a result of these issues, and because land buyers, or excuse me, land sellers still believe that their land is as valuable as it was 2 years ago, it's very difficult to get deals to pencil. So not only do we need districts, in this case, we're going to talk about MUDs, but we need to be able to bring the money, the MUD money into the pro forma sooner rather than later. So we need the MUD and we need the money sooner rather than later. The challenge that we've had in Texas up until we at launch invented the forward funding concept, and I'm going to get into that. The only real way to accelerate cash into the pro forma using municipal districts or tapping into the municipal bond markets was through the PID. And there we were having to deal with the jurisdiction. We're moving at the speed of bureaucracy, let me just say that. And which sometimes is fast, more than likely it's very slow because it's very bureaucratic. And then we're issuing bonds to build out of bond proceeds, which is good. However, now the negative related to that is that the cities have been sticking out their hands, not all of them, but most, saying, by the way, we'll give you a PID, and if we do, we want 10% of the bond proceeds to fund improvements that we need for the city. So those improvement dollars may not be flowing into the project. In some cases they are, in some cases they're not. But we're having to not only go slow at the speed of bureaucracy, but now the cities have got their hands out wanting us to build infrastructure that may or may not benefit our project. So there has to be a better way. And in our opinion, the launch bond is a better way, provided we have a MUD, an MMD, freshwater supply, or any of the other Texas water code. So let me get in and just talk a little bit about the history of how we came here to literally be changing the landscape of infrastructure financing in the state of Texas. So when I first came to Texas in 2007, we knew about the MUDs. We knew how they worked. We thought they were really great. But the issue that we were always facing is, how do we accelerate dollars from the MUD into the pro forma? And the only way that we could do that prior to the invention of the forward funding concepts, which is the launch bond, was to sell those future reimbursements to a private investor. And the private investors were more than happy to take your reimbursements off your hands if you were willing to pay them on average, which was about a 15% discount rate. So the concept of selling their reimbursements was out there. However, it was very, very expensive. So with this percolating in the back of our mind, how can we sell these reimbursements, but somehow be able to do that in a tax-exempt, non-recourse fashion? We started thinking about other ways that we could work within the MUD framework, which is all the Texas Water Code, which is the TCEQ, which are the different agencies or districts that are going to own and operate the infrastructure, and but we needed a different set of rules because the rules in Texas only allow us to issue, and this varies, but let's just say 10% of the assessed valuation in bonds on an annual basis to reimburse developers for advances they've made to the benefit of the MUD. So I started thinking and had worked with some other Texas developers on a conduit financing. And I thought, what if we were to take this whole idea of the selling of the future reimbursements and combine that with a conduit, and we could issue bonds out of a different state's enabling legislation, and sell that as a tax exempt bond to the municipal bond market. So that was the idea. The key was we needed to be able to get a legal opinion from a bond counsel that this would be a tax exempt bond transaction. We were able to find a firm out of Chicago. I should mention it didn't come from Texas, that was willing to allow us to work with the MUD attorneys to understand how MUDs work, how infrastructure is constructed, owned, and operated, how funds are advanced, who owns the infrastructure, when is it owned, how is it maintained. So this law firm sat down with the MUD attorneys, and they went through all of the processes, and eventually they came up and they said, Carter, if you're able to craft the launch bond in this manner, we'll give you a tax exempt bond. So that was the backstory of how we came here. The project you see on the screen is the first one that we had done, which is the proof of concept, which is the first MUD forward funding that was ever done in the state of Texas that we created. And thank God for Randy Rollo and the Rollo family and his project called Lariat, located in Williamson County, because this is where the forward fundings began. And this was the proof of concept. And since the Lariat transaction, which I'm going to show you later, was done in June of 2023, there have been over $2 billion worth of forward fundings that have been done. Okay, so that's the backstory on the launch bond. So the launch bond really works as a bridge between the early stage construction of infrastructure on a phase, on a project located within a MUD, and when the MUD begins to issue debt to repay the developer. The key thing is that the developer is just assigning their rights under the development financing agreement with the MUD to the launch bond buyer to have the MUD proceeds, rather than going to the developer to repay the advances made by the developer, to the launch bond buyer. And I'm going to show you a diagram to make it clear. To be clear, this is non-recourse to the developer, and it does not show up as an encumbrance on the land. It's strictly an assignment of the developer's rights to the bond buyers to receive MUD proceeds until the bond is paid off. This is a tax exempt bond. The launch bonds follow the MMD index, so they fluctuate as Fed funds go up, Fed funds go down. So it also, they also go up and down depending upon the credit quality of the development. Should the launch bonds pay off sooner than had been expected, the benefit accrues to the developer. To the extent that it extends longer than had been intended, then the more MUD proceeds are going to go to the launch bond, and the developer will lose some of the what we call the tail of their MUD financings. Every one of our deals that we have done to date, and there have been myriad, all start off with us sitting down, understanding what our client is trying to accomplish and what their specific DOS issues are. So as part of this, we're looking at how much money do you need? When do you need it? What are your current equity and loan facilities? Do you want to pay them off early? Do you want to maintain them? Do you want to reload your revolver? All of these questions are important to us as we structure our transactions, because here again, we want to be a hero to you. The only way that we can be a hero to you is to custom, to the extent that we can, our financings to match your goals. Okay, so let's get into uh, a little bit of mud cash flows. I love pictures. And this is oversimplification of a mud cash flow. So please don't send me emails saying, Carter, you got it all wrong. This is just concept. So if we're a developer and we have a mud, typically what we're doing is we're expending dollars in the early years of our project to build offsite, onsite infrastructure, to secure contracts with builders. In some instances, we may be building in tracks, we may not be building in tracks. The builders may be building the in-tract improvements or the pod improvements. They may get mud reimbursements as a result of that. They may be signing their mud reimbursements to the master developer. Everything's different. But anyway, we're having a developer advancing funds for the benefit of the mud and building this infrastructure. At some point, once the mud has levied its O&M or its M&O tax and it has sufficient funds, to administer the district, we're going to begin to issue mud bonds. Those mud bonds flow back to the developer simplistically to reimburse the developer for eligible WS&D costs. If they have road powers, park powers, to pay those back as well, plus interest on the infrastructure dollars that they've advanced. Pretty straightforward. The MUDs are issued every year until such point in time as the developer has been reimbursed. The key thing to remember, and I'm a CPA, I'm not an attorney, so take it for what it's worth, is that the developer finance agreement with the MUD is a contract, and it is an enforceable contract. So if for some reason the MUD does not issue debt, that the case law in the state of Texas allows the developer to be repaid either by forcing the MUD, in the case that we have a landowner, or excuse me, a resident or homeowner board, to issue debt to repay the developer or to levy it through their M&O tax. This will become important as it relates to the launch bond. I just want to throw that out there for right now. So here's how MUD typically works. So what does a launch bond look like? Well, the launch bond is the same process. We have the developer expending dollars in years 1, 2, and 3. At some point, we are going to be issuing a launch bond. That launch bond is secured by the developer's assignment of their right to receive the reimbursement through the development finance agreement to the bond investors. The MUD, when they issue bonds, okay, and this is key. The MUD is doing what the MUD always does. We're not changing that at all. The MUD financial advisors are doing what MUD financial advisors do. The district attorneys are doing what the district attorneys do. The TCQ is doing what they do. Nothing changes with the issuance of the MUDs. It's as it's always been. The only difference is who gets that money. So what happens when the MUD issues its bonds on its regular cadence, whether it's a ban or a bond, that goes to the trustee. The trustee looks and says, okay, the developer has assigned their right to the launch bond holders, so we're going to forward those funds to the launch bond buyers to pay accrued interest and principal. That occurs until such point in time as the launch bond is paid off. And when the launch bond is paid off, then the flows fund back to the developer, just as it's always been. So that is really what we're doing. The launch bond is being issued through a conduit. So the TCEQ rules, 10% of AB don't apply to us. However, all the TCEQ rules, water code rules, still apply to the MUDs. Key, we're not upsetting the apple cart. We don't want to upset the apple cart. It's just a matter of who gets the MUD proceeds. Okay, so hopefully that's clear. So now we're going to get into a little bit of math. And to get into a little bit of math, I need to set the table on our imaginary project that we're going to be discussing the launch bond sizing, and then also showing the pro forma results of lot sales and MUD reimbursements under the traditional format and then the launch bond format. So don't geek out too much on these numbers, guys. This is just an example. Just pay attention to the numbers. So in this project, we're assuming we have 1,800 lots. We've got about a 500-acre project. Average home price, $335,000. We're going to build it out over, let's call it 6 years. We've got our land basis of $38,000 an acre. Our blended cost of capital for both debt and equity is 10%. When we're borrowing funds, our leverage is 60% of costs. We got $122 million worth of total infrastructure costs, of which about 80 million is MUD eligible. We've got a MUD eligible total maximum tax rate of $1.50, and what we're using for debt service on the MUD is 90 cents. So big picture, don't get wrapped up in the details too much, but these are assumptions we're going to be utilizing. So first thing, it's really important that I lay out a little bit of the how we do a launch bond sizing. This is the only math that we're really going to get into, guys, and then we're going to show results. So in this instance, we have gone in and we have calculated, or the MUD financial advisor has given us the MUD proceeds that are anticipated to be developed over time. And in this instance, we're showing that the MUD proceeds are going to be coming in 2027. We're going to be getting $7.9 million in 2027, and then 10 million, 18 million, etc. This is coming from either a market study that John Burns, Zonda, Concord Group, RCLCO, CBAS have done, and we're giving that, and we're either running the numbers or the financial advisors are running the numbers. But in this instance, over time, the developer is going to net out $63.2 million in MUD bond proceeds. When we are issuing a MUD bond, we're trying to tell a story to the bond investor. And we're going out and we are saying, hey, bond investor, we've got $79 million worth of infrastructure that's MUD eligible. The financial advisors have shown us that we're going to be able to issue bonds netting out about $63 million. We've got this market study by a third-party data source, and we have a very viable project. We have builder contracts. They're on all the lots, etc. So the standard kind of credit underwriting is to use a 1.5 debt service coverage ratio. So in other words, we're able to make sure that we have enough money to pay off the launch bond over time. So why is that important? In this instance, we have a 1.5 debt service coverage ratio. So if I take 1.5 and divide it into 63 million, I get 42 million and change. If you take a look at the net debt service proceeds column, you'll see here that in this instance, issuing a $36 million bond, we're going to repay the launch bondholder $42 million. So that represents a 1.5 debt service coverage ratio on $63 million coming in. And assuming a 6.5% interest rate, we back into a $36 million bond. We have our cost of issuance. So in this instance, the developer would be able to issue a bond in 2026 of $34.3 million. Over time, the MUD is going to issue bonds until such point in time. In this example, we're showing 2030. The launch bond will be paid off. At that point, the remainder of the $6.9 million will go to pay principal, accrued interest, some trustee fees. The remaining 1.2 flows back to the developer. So we have two different scenarios here, guys. The launch bond scenario is to get 34.3 million up front, forego MUD reimbursements for 3 years until the launch bond is paid off, in which case you're going to be netting out $55.3 million total, or the do nothing scenario, which is your standard MUD bond issuance process. You're going to get more money, 63.2 net. However, you're going to have to wait over time to get that money. So the way for us to be able to play with the levers of IRR, and to be clear, those levers are margin, velocity, and duration. If you want to learn more about IRRs and how to manipulate the levers, what I call the levers of IRR, go listen to my podcast, Land to Lots, episodes 52 and 53. That's Land to Lots, episodes 52 and 53. So let's just keep this in mind as we move forward. Remember, under the MUD, the do nothing scenario, the MUD scenario, we get 63.2 million over time. With the launch bond scenario, we get 34.3 up front. We're netting out 55.2. So let's get into the pro forma, shall we? So this pro forma relates to the figures I had given to you earlier, where we're selling lots, where we're funding infrastructure, we're issuing our MUD bonds over time. This is the do nothing scenario. This just represents if we're going to be expending dollars, selling lots to builders, and issuing our MUD bonds. What does this look like? So in this instance, we're showing the developer MUD reimbursements coming in beginning in year 4. So obviously we've started earlier in the process than what we're showing in our launch bond estimates. But you see here, we're getting the $63.2 million coming in time with the first MUD bond being issued. And so you see here the 79 or the 7,951,000. So you can see that being issued in year 4. So what does that do? And here again, guys, I just want to focus on totals and IRR. So in this instance, we show the 63 million coming in. We're netting out total revenue sources of 213.4 million. We're backing out all of our various costs. And the other thing I want you to pay attention to is this financing costs. Okay, remember we have a weighted average financing cost of 10%. Well, in the do nothing scenario, our total financing cost is 16.9 million. So in our example, total expenditures 159, total revenue 213. Our net cash flow is $53.9 million. With, when you run the IRR, it's a 16% internal rate of return. So hopefully this is fairly this fairly standard. This looks familiar to your pro formas on how revenues come in and how dollars are expended. So what happens? And this is the crux of our discussion today when we issue a launch bond. Same assumptions, but we're now going to be issuing the launch bond. So what happens? Still have the same revenues, okay? However, look at this. Our developer reimbursements are coming in. It's the 55.2 million. It's no longer the 63, but we're getting 34.3 million in year 3. Okay. Whereas before we were only getting 7.9 million in year 4. Look what happens. Our total revenue is down. Okay. Before we had 213. The primary difference being the developer reimbursements. But look what happens with our expenditures, meaning our total outflow is 150 million, whereas before it was 159 million. Well, what changed? Well, the big change is the financing cost. Because we were able to bring in tax-exempt financing earlier in the process, we were able to lower our overall cost of capital, which was in our example 10%. So look at this. Our financing costs have dropped to $7.8 million. As a result, our total outflows have gone down to 150. Just to flip back, they were 159. And our net profit or cash flow has increased to 55 million. So what has this done to our IRR? Well, look at this. We bumped it up to 22.7, which is a percentage change of 42%, guys. By doing the launch bond, we have enhanced our IRR by 42%. Drum roll. So what does that look like in terms of a summary? With the do nothing scenario or the no forward financing, we're netting out $53 million and a 16% IRR. Not bad, but with the launch bond, we're able to increase our net profit to 55 million and the IRR to 22.7. The primary difference is even though we're receiving $7.9 million less in proceeds, we're getting that sooner into the process. And as a result of that, we're decreasing our financing costs. We're increasing our margins because we have a lower financing costs, and we've accelerated the velocity of our money into the cash flow, which has increased our IRR 42%, or in this case by 677 basis points. That is the power of the launch bond. So, what are the benefits? Just to summarize: number 1, lower cost of capital. Number 2, enhanced investment returns. And 3, we're able at launch to bring you a launch bond within 4 months from the date you say, Carter, go. Our team will have that money in your bank account in 4 months. The shortest we've ever done one is 75 days. But the difference is that now we are moving at the speed of business rather than the speed of bureaucracy, meaning we can go to town really quick. Getting into some of our clients, this is a list of some of the developers that we've worked with to enhance their IRRs. And what I'd like to do is to be able to show you a couple of different transactions that we've done and show you some firsts. These are not all the firsts. Just about every deal we do is a first, meaning it's never been done before. We're creating it, and we're creating it based on our client's DOS. Here again, remember, and why I really went into the detail of who we are and what we do, is we only work for the private sector, and we want to be a hero to you, the development and home building industry, And so everything we do is to stay on your Christmas card list to be a hero to you. So let me get into a couple of financings. So this is the proof of concept. This is where forward financing was born in the state of Texas. $2 billion issued to date have been done based on the concept that Randy Rollo and his family allowed us to use their project. I hate to say as a guinea pig, but as a test to be able to prove the concept of the tax exempt, non-recourse forward funding of MUD receivables that is called the launch bond. And in this instance, we issued a $35.5 million bond. Randy had about $42 million in the ground that he and or the home builders had put in the ground. We were able to net out $33.2 million. Some of that went to pay back his lender. The remainder was utilized to finance the construction or the reimbursement of the wastewater treatment plant that Randolph, Texas, was contracted to have to build as it related to their contracts with the home builders. We're able to finish phase 2 of the wastewater treatment plant. And because this was the first one ever done, it priced a little higher because the market had never seen this before at a 7.5% interest rate. It was sold at a discount, so the yield was 7.76%. But this is where it all started, guys. And Randy, if you're listening, thank you. The next one is Starwood. I called up Mike and the folks and John at Starwood and said, "Hey guys, this is an interesting concept we just did for Randy Rollo. Maybe you'd be interested in monetizing some of your reimbursements for the Land Tejas assets," and they were interested. And what we did here is we rather than doing multiple different bond issuances, we brought together 4 projects, 10 MUDs, and basically did one bond issuance, in this case, $165 million bond. Because we did this at a current interest bond, and we're not going to get into the difference, but typically there are 2 types. One is a capital appreciation bond, which is what we did with Randy, which is very close to a zero coupon, meaning there are no scheduled interest payment dates. It just accrues interest with the stipulation that all MUD bonds, should they be issued, have to go pay back accrued interest and debt and principal, excuse me. With the current interest bond, there are scheduled interest payments that need to be met on certain dates. The Starwood transaction was set up as a current interest bond. As a result of that, the interest, there was a reserve fund of $9.1 million. The coupon and the yield were 5.5%, and Starwood netted out $150 million on this transaction. So the point I want you to understand is every client has a different need. Every client has a different situation. And what we do is take that need and that situation, and based on 42 years of dealing with infrastructure finance and dealing with the bond world, we craft a custom strategy that we can present to the bond buyers to have them invest in your vision. So, Starwood transaction. This is another real interesting one. This is called Thomas Ranch, and Thomas Ranch is outside of Austin. We had a client that was interested in really forward funding the construction of infrastructure, or to set that up more as a progress payment, progress reimbursement. And in this instance, we were able to issue a $106 million bond and net out $103 million in proceeds. And as the developer is financing and paying for infrastructure, that is being reimbursed by this $103 million worth of net bond proceeds. This was done as a capital appreciation bond, 6.5%. But here again, us looking at what our client's trying to accomplish, and then looking at how we can accomplish that goals. given the different frameworks that we have to work in as it relates to the state of Texas. And uh, that's really the last transaction I wanted to show you. I want to be cognizant of your time, but if you would like our slides, if you would like uh, us to give you a discovery call, I'm going to give you an opportunity now to take a shot of this QR code. In a minute, I'm going to show you the QR codes for Ryan Mills in our Dallas office and Jose Almazan in our Houston office. And you'll be able to set up a call directly with them, and they will be able to send you the slide deck as well. But more importantly, let us help you. If you've got a project that you would like to investigate the potential of utilizing a launch bond, reach out to Jose, reach out to Ryan, reach out to me, set up a call. Let's get your numbers. Let's run an analysis for you so that we're able to turbocharge your project returns on any project that is utilizing a Texas Water Code District, MUD, freshwater supply, WCID, MMD. We're here to be a hero to you. Thank you very much for your time. I appreciate you spending a little bit of your morning with me and with us. Thank you.